2004. And that, whenever there's a lot of volatility, you call in all of those people. It's not, you have a lot of assets that you have to watch at the same time, and you're trying to figure out how to de-risk them. And so on the risk management side of those firms, you have various rules around the assets you own and how you deal with them. And you can cut things a little closer and work with a little more margin if you have more people working that set of assets. Theoretically, if you have, one person for each asset you have, and they're just watching that go up and down, then okay, if it starts to go down too far, you have an individual who's going to be making decisions about it. When you're less staffed, that process tends to be a lot more automated. The problem you have there is kind of the same problem ETFs have, where once it starts moving, it moves really fast. We talked about it earlier that if you want to sell a stock, someone out there has to want to buy it. That every trade has two parties. And so that's why things like crashes happen so quickly, because if I want to sell stock and no one wants to buy it because it seems horribly risky, or Trump's going to screw it up with tariffs or whatever it is, its price goes to zero. There's some level at which people will buy, but we don't really know where that is. But if you have that, active management for the asset, then you can cut that a lot closer than you can just going like, well, if it goes down more than 10%, just dump all of it, which is kind of what the automated systems will end up doing.
I mean, that's what you see a lot of the times in the market when you have this sudden, just feels like the floor comes out from under you. Is that, and the specific stocks? Though I did see it last week a little bit with the indexes, so I wonder if there's something weird about ETFs or institutions where they have like the institutions are indexing things or marking things on the indexing, saying we're going to move here.
So one of the things you have if you're doing risk management at like a big institution, someone like say BlackRock or Goldman, is you have some points that on your risk side that become automated because your risks have exceeded the firm's tolerance. And now you don't care what's going on, you want out.
Makes me think of, they were talking about margin calls over this weekend.
Right.
It's like an internal version of that. Instead of you imposing it on someone else, you're imposing it on your own.
Well, and so a margin call externally, say with your broker, you actually have some slack in that process. Usually with most firms, it's like 3 to 5 days normally, where they'll say, okay, because normally when you get a margin call, it isn't because of a huge event. It's just because you've screwed something up.
You just got to rebalance because you've come out of the wreck.
Right. And so what happens is at firms and at brokerages, you sort of have what is your tolerance in margin calls, or what is your tolerance for margin? And the more out of the money your investors get, you start dialing down how much margin you'll allow them to hold. And so that's how you get that sort of accelerating thing where as it starts to go down and you start margin calling people, your firm's internal margin coverage needs to go up because the assets are riskier. So you give people less margin, so you margin call more people and, sort of drive the whole thing into the ground. One of the things that I think we're going to see out of this really quickly is also particularly related to ETFs. Most ETFs now are very automated traders. They're doing something like, say, following an index because that's the lowest cost way to manage money is just say, well, okay, everyone who's in the S&P 500. And I think one of the things we're going to see with this is, your ETF isn't actually the S&P 500. It's all these individual stocks as interpreted by a robot to perform the same way the S&P 500 does.
Right. It's a representative set. So you get this representative set that moves in the same direction, but it's not a one-to-one.
Right. And the faster things move, generally, the further apart those two things get.
Yeah, when I
Um,
but first-hand experience, I did a lot of my stuff during the Trump-China round one fights with tariffs. And a lot of that was just jumping in and out of ETFs, and depending on which ETF you selected, how they did their mixes, that was a significant part of me choosing which ones to play with, because some of them would, they wouldn't go up as much, but they would come down farther, that kind of thing.
right. Also, ETFs, they have to decide how often they want to rebalance the ETF against what investors are doing with the fund itself. So if we have, say you have 1,000 shares of an ETF, and for reasons you decide to sell them, the ETF does not then immediately sell thousands of fractional shares of all their underlying assets. They just pay you out of cash that the ETF holds that comes out of the management fee the ETF takes, and then generally they rebalance it. And in environments like this, that can hurt really bad.
Where I think we sort of talked about this another time, was that there are certain mechanisms in the market where if you push them too far, things start to creak and crack. And I mean, not really one-to-one with this, but we talked about the inverse VIX failure, where just the fundamental structure of the thing broke
Right,
at a certain point because it was going too much in one direction that
right.
caused
It
a
was
bunch of
so
math to
far
fail.
outside. Right. Well, and when you go really far in one direction or another, when you're developing an ETF that's say going to follow the S&P 500 or something like that, you look at correlations. And so one of the things we talked about earlier in that chart I posted is how this event is breaking traditional correlation rules. And that's an incredibly dangerous place for an ETF to be. Because if you're an ETF and you go, okay, well, gold has, say, a negative 90% correlation to the S&P 500, you may elect to use buying gold or shorting gold as part of how you're going to deliver your S&P 500 ETF. You don't have to just deal with the things in the index. You'll use all these other tools that are available to you, because you ideally don't want to go directly into the index stocks, because then you'll be the one moving the index and you're sort of trading with yourself. So you'll use things like gold or futures or, other types of assets that you can buy. And when those correlations break down, that means that like the underlying premise, like the investment thesis of the ETF is now false. This set of assets no longer correlates to the thing that it says on the box that it should correlate to. It correlates to something else.
Yeah, I mean, it breaks the. If you've ever watched investment television, CNBC, whatever your pick is, Bloomberg, the commercials will always throw in these ETFs, and they describe them as you're investing in all of this other stuff. But that's the premise that breaks at that point, is what are you actually, what's actually
But what
inside
is
the
the
box at
underlying
the end of the day.
asset?
Yeah, because you
And
don't get to see inside the box. They do.
I did want to note to the Sage that for Thinkorswim and a few other platforms, you can in fact make an inverse Kramer. There's a Think script that will do it. So not Kramer. So
Mad Money.
Yeah, who by all accounts is a really nice guy, by the way, is apparently nice. And when people talk to him individually about finance stuff, he's very sharp, but
But he has
trading
his
against
own.
Kramer is.
He just likes to open his mouth a lot. So when you
Yeah,
open your
well,
mouth
I
all the
mean,
time, you become famous for saying dumb things at dumb times.
well, he does have to fill like 3 hours every day. It's like him and, I don't know, conservative talk radio hosts. I did like there was someone in markets and finance who came up with the idea of okay, we could do is you have inverse Kramer and then you have long Pelosi because those should be able to be balanced into a net neutral position on the market.
That's funny. Hey, did we? That's something for another time. But I do want to check in on where we ended up with the whole. Are we going to limit our politicians from investing in things? I know it's not.
Not
We have
happening.
not.
It's
But
not happening.
yeah, is it dead in the
Um,
water completely now? I guess so.
it is dead in the water for now. Some states are doing it at the state level now, where they're forcing new financial disclosure laws upon their politicians to specifically tell them what assets they are in ownership of.
And
I will say, so I've gotten into this too much here, but I'm very much like Chicago school efficient market sort of person, and that I believe the main way one earns returns is information asymmetry. That being said, to me, if you follow that sort of ideological line to its conclusion, then you end up with insider trading sort of is and isn't a thing. That being said, with politicians, you're talking about the people who actually make some of those decisions. And so you have, are we going to buy this jet from Boeing or Lockheed? It's always felt very gross that you could have some senator who's like, well, I have 1 million shares of Boeing, so let's do that one. Like that feels almost like Teapot Dome-esque.
Well, you get this.
yeah, and
There's a whole like correlation thing that it's like it's not directly aligned,
Actually-
but they're moving together.
So I have a regulatory question. So I know when you are an officer in a company or you learn, privileged material information, you can't trade based on it. Can you trade if you learn about it from an elected official?
so fun question. And I'm going to the
And I'm going to
actual-
cite your advice when I get in trouble.
please do not do that. Please do not do that. And for folks who were joining later on, I work in financial crimes for a major financial institution. One of the things that I cover and very very limited among my team is securities fraud, including things like insider trading. And so this is a fantastic question, especially like the intersection of politicians and insider trading. That when we're talking about insider information and what insider trading um, is that this information, so it has to be material information, so something that that is could reasonably affect a investor's decision making, and it has to be non-public, so of course, as the word says, not known by the public, but it has to be in breach of a duty of trust or confidence. And I'm quoting the regulation directly here, on basis that it's in breach of a duty of trust or confidence that is owed directly, indirectly, or derivatively to the issuer of that security or the shareholders of that issuer, or to any other person who is the source of the material non-public information. And I think that you would be so there's the classic theory of insider trading and like a misappropriation theory of insider trading. Classic theory is going to be pretty limited to like employees and associates of a company, of issuer, and so that's going to be that duty of trust or confidence is owed to the issuer.
So my fun
But
thesis of
if
flying drones outside their windows is acceptable.
so, of flying drones outside the company's windows.
Yes.
I mean, theoretically, that
So
it could be.
I'm
I mean,
actually aware of that
yeah.
one happening.
Yeah, I mean, I would say that you probably could prosecute somebody successfully for insider trading based off of that. Um, the but where we get into like the misappropriation theory with the regulatory definition is that any other person who is the source of the material non-public information. And I don't think the SEC or DOJ would ever feel strongly enough that that would include learning the info from a politician or something. That, I mean, that's really directed towards being tipped off by the employer or by an employee or something like that. You know, that would be in
So what you're telling me is
breach
that
of that duty.
congressional intern / hedge fund manager is the most lucrative job in the world.
In theory, sure. I mean, because yeah, the thing is that you ask what is this duty of trust or confidence, because that duty of trust or confidence to any other person who is the source of the MMPI, really that person needs to have some duty of trust or confidence to the issuer. Now, where it gets a little bit fuzzy-ish with how this regulation is worded, but versus in practice, that if
We should really do a whole one
you
of these talks
were,
on this subject because
yeah, I mean, yeah,
it's
absolutely.
fascinating to me as a thing.
Yeah, so if you work for a company and you receive insider information and then you go trade in one of your competitors, that's still insider trading. If you tell your friend or whoever, that they would then be insider trading as well.
Mhm.
And so basically your duty of trust or confidence extends by proxy to this other person, and that's
Right,
why
to all the
yeah, but a politician
I would be
has
curious.
no duty of trust or confidence to the issuer of the security. I mean,
I
you can
would
argue
be
they have a ethical
an ethical
duty
obligation, but yeah,
to the public, but from a legal perspective, it, there is I can think of no legal reason that a congressman or any other politician could not trade based off of what they know as a congressman or as a politician. It's unethical. Obviously, that's why there's discussions of reforming this. Um, but it
right.
is
Well, and I would
it's
be
illegal. So yeah, if you learn from a politician information, then um, that
off you
is
go.
off you go. You're fine. You can do that. Now
Now,
likewise, if
I
you're
w-
on the subway or Amtrak or wherever, and you hear somebody else talking, and again, don't quote me on this, because I will not testify in anybody's defense here, um, but uh, my understanding, what I have been told and what I have read from case law and stuff, is that if you overhear that in public, you don't have any connection to that person. They're not telling this to you. You just simply overhear it at a restaurant, on a train, on a plane, wherever.
they have made
Um,
it public.
that they have made it public. You have no duty of trust or confidence to that person. You have no duty of trust or confidence to the issuer of the security. You you couldn't be prosecuted. Now you
But
might be
And that does
investigated,
lead to
but
something that yeah. This is also that one of the things we haven't really seen is there are multiple accounts on Twitter and things like that that follow how politicians invest. And it is interesting to me that you don't really see any of them taking, call it, material positions that relates to tariffs. You've seen them kind of short companies that are obviously exposed, but normally something that would be a workable sort of source of guidance on what to do just isn't there.
You
You
or
know,
I
and I
do
think
think
with,
it
so with
would.
I'll jump in on that one real quick. With that statement, you were assuming that the tariffs were communicated appropriately to the people many of those accounts watch, which are usually in the legislative branch. However, we've seen with this and with some other things over the past really 70 days now that they consultations with the legislative branch tend to be an afterthought or upon being called forward. So I wouldn't necessarily think I wouldn't assume they were given a heads up as to how the severity of the tariffs.
I
Also,
mean,
I
it
don't think
probably is
anyone
similar
knew
to.
that it was going to go this far.
I don't even think there were people in the White House that seemed like they didn't even know that was going to be the way it
well,
was. So
and since there's not a clear cut because you don't have like a clear cut way that you would trade something like tariffs or these kinds of tariffs like we talked about earlier, there's not, that also means there's nowhere to, even if you did know ahead of time, it's okay, well, what trade do you want to place?
I mean, it would basically be. I was going to mention this earlier, but when you're
Sell all
going to
your
cash,
shit?
being the first one to go to cash, that's the winning play. And then being the first one to go back into the assets that are advantageous, because
And I
that
did
that
So
kind of margin would be the thing that you would get. But I would also like to mention, because we've been talking about law and finance, none of us are giving anyone advice here,
Yeah.
and
I
just want to
plan,
clarify that.
you said that after the fact. I plan on citing every word of this conversation in my criminal defense.
Tomorrow's journey planned out.
And now it's
I will
silent.
I will point out that there were a couple of politicians that, looking at their trade history, would indicate they've gone cash rich recently over the past couple of months. And I'll leave y'all to go through, since this is an OSINT server, to go figure out who those people were.
And one of the other things that I would say about like politicians and trading and stuff is that, yeah, we see on Twitter, we see on Reddit, we see other places, this politician's trading this politician's trading that. How does this correlate to their ongoing legislation, or does this happen ahead of some sort of major news announcement? Was this related to something that they know? And while it may be possible, that that some of them are trading on things like that, that I think by and large that they're also, a lot of them are rather boring in how they trade. Or also when they make some of these trades ahead of some sort of news in the world, that it's not something that should terribly be surprising. That a lot of reasonable investors could make similar decisions. And especially if you have an advisor who is paying attention to the news and making general
Right, we'll make the
guesses.
same kinds of
Yeah,
decisions.
that a lot of these things, it might seem odd because they're high profile. But it doesn't
But they're reasonable
necessarily,
positions to take.
it doesn't necessarily indicate any sort of nefarious intent, because it can be a perfectly reasonable investment decision.
Well, I mean, and going back to the economic theory thing, that it's the current price is a reasonable price. So someone buying at it is being fairly reasonable, and someone who sells at that is fairly reasonable. So,
Yeah.
One of the things that's come up a lot on the server with just sort of like what people do is, you know,
Yep.
people have retirement accounts and things
All
like
right, hold
that
on,
where
wait.
they're trying to figure out like, okay, this big thing is happening. The market's moving a whole lot, and like, what's next? And I think one of the things that's particularly frustrating in all of this is that, you know, normally when you're working as an analyst, you're doing risk management, fund management, that sort of thing, you have some idea of what you would do in different hypothetical like scenarios. You'll have different theses that you'll use based on what the market's doing and those kinds of things. And this sort of goes back to that thing where, because none of the education around that industry even contemplated this as an option, you have this sort of paralysis, both, you know, in the space of like public analysts. I mean, even, you know, people talked about Kramer earlier, and, you know, he said everything from, you know, prices are lower, it's a great opportunity to buy, to like everyone's screwed on Monday in like within 5 minutes.
Yeah, I do want to talk about that in a second. I don't know if you want to wrap this part up, but
Yeah, sure, we could do that.
The big question of the day: how bad will tomorrow be? And I feel like I feel pretty
So
safe saying that if nothing changes, yeah.
if you believe in completely efficient markets, we can answer that question right now.
Okay.
Let's take a look.
Yeah, because I'm getting the feeling